Imagine your money working for you, earning a steady income stream month after month, even while you sleep. A lot of people think that kind of financial freedom is just a pipe dream, something totally out of reach. But what if I told you that with a simple, time-tested strategy, you can start building your very own passive income machine? What if the path to getting paid by the world's biggest companies was way more accessible than you ever thought? In this video, I'm going to show you exactly how to do that with dividend investing. We're going to break it all down step by step. We'll cover everything from the absolute basics to the specific strategies you can use to start generating real, reliable passive income. Forget the confusing jargon. By the end of this video, you'll have a clear roadmap to turn your savings into a real source of income. So what exactly is a dividend? All right, let's start at the very beginning. The word dividend gets thrown around a lot, but what does it actually mean for you? Think of it this way. When you buy a stock, you're not just getting a little ticker symbol on a screen. You're buying a tiny piece of an actual business. You become a part owner. And when that company does well and makes a profit, it has a choice. It can pour all that money back into the business to grow even bigger, or it can share some of those profits directly with its owners. That's you, the shareholder. That share of the profits is the dividend. It's a direct payment from the company to you just for being an owner. Most US companies that pay them do so quarterly, or every 3 months. So 4 times a year, you get a cash deposit straight into your brokerage account. It's your reward for investing in a successful, profitable business. Now, you'll often hear the term dividend yield. This sounds more complicated than it is. It's just a simple percentage that tells you how much income you're getting compared to the stock's price. For instance, if a stock costs $100 per share and pays out $4 in dividends each year, its dividend yield is 4%. It's just a quick way to compare the income potential between different stocks. And here's a little bonus that makes dividend investing even sweeter: taxes. In many cases, the dividends you get are considered qualified dividends. This is just a fancy way of saying they get special tax treatment. Qualified dividends are often taxed at a much lower rate than the income you earn from your job. For many investors, this tax rate can be 15%, and for some, it can even be 0%. This tax advantage means you get to keep more of your hard-earned passive income. So, to wrap it up, dividends are your slice of a company's profits, paid right to you, often with a nice tax break. This is a huge part of building wealth, because it's not just about hoping your stocks go up in value. It's about getting paid while you wait. The 2 main strategies for picking stocks. Now that you get what dividends are, the million-dollar question is, how do you find the right dividend stocks? Because not all dividend companies are created equal. Generally, investors follow 2 main strategies, and knowing them is key to building a portfolio that fits your goals. The first strategy is dividend growth investing. This approach isn't about chasing the highest dividend yield today. Instead, it's about finding super stable, high-quality companies that have a long, proven track record of increasing their dividend year after year. Think of it as getting a raise every single year, but from your investments instead of your boss. The rock stars of this world are called the dividend aristocrats. To get this title, a company has to be in the S&P 500 and must have increased its dividend for at least 25 consecutive years. These are companies that have survived recessions, market crashes, and all sorts of crises, all while continuing to send their shareholders a bigger check each year. We're talking about household names, companies like Procter & Gamble or Johnson & Johnson, that have shown decades of financial strength. The starting yield might look modest, maybe 2% or 3%, but the real power is in that consistent growth. Over time, as the company keeps raising its payout, that 3% yield on your initial investment could grow into a 5%, 8%, or even 10% yield. This strategy is perfect for the patient investor who wants reliable, growing income for the long haul. The second strategy is high dividend yield investing. This one is all about getting as much income as you can right now. People using this approach look for companies paying a higher than average dividend, often in the 4% to 7% range, or sometimes even more. This can be really appealing because it means you need less money up front to generate the income you want. You'll often find high-yield stocks in sectors like utilities, energy, real estate, and telecom. Think companies like Verizon or certain energy pipeline partnerships. These businesses tend to have super stable cash flow, which lets them pay out a bigger chunk of their profits as dividends. But, and this is a really important but, this strategy comes with more risk. You have to do your homework to avoid something called a yield trap. A yield trap is a stock that looks amazing on the surface because its dividend yield is sky high, but it's actually a massive red flag. Remember, the yield is just the dividend divided by the stock price. So if a company's stock price is tanking because the business is in trouble, the yield will mathematically shoot up, making it look tempting. Investors who jump in, lured by that big number, might find that the company slashes or even eliminates the dividend, leaving them with a huge loss. So when you look at high-yield stocks, you have to be a bit of a detective. Check the company's financial health. Is its debt under control? Is it making enough cash to actually afford that dividend? A key number to look at is the payout ratio, which tells you what percentage of the company's profits are being paid out. A ratio that's consistently over 80% or 90% could be a warning sign that the dividend isn't sustainable. So which strategy is for you? It really depends on your timeline and how much risk you're comfortable with. Dividend growth is often seen as the safer, more conservative path. High-yield investing can get you more income sooner, but you have to be more careful to avoid those yield traps. Honestly, a lot of successful investors use a mix of both. Before we get into the absolute easiest way to get started, if you're finding this helpful and you're serious about building a passive income stream, do me a quick favor and hit that subscribe button and turn on notifications. I put out videos like this every week to give you clear, actionable advice to help you build wealth. It's free, and it means you won't miss what's next. Section 3, the easy button for dividend investing. ETF okay, so we've covered dividend growth and high-yield stocks. For some of you, the idea of digging through financial reports and trying to dodge yield traps might sound like a ton of work. And you know what? It can be, but what if there was a way to instantly own a diversified portfolio of dozens or even hundreds of top-notch dividend stocks, all with a single click? Welcome to the world of dividend exchange-traded funds, or ETFs. Just think of a dividend ETF as a basket that holds a whole collection of dividend-paying stocks. When you buy just one share of the ETF, you're buying a tiny piece of all the companies in that basket. It's the ultimate easy button for dividend investing because it gives you instant diversification. And there are dividend ETFs designed to fit both of the strategies we just talked about. For example, if you like the dividend growth strategy, there are ETFs out there that specifically track companies with long histories of raising their dividends. If you'd rather go for the high-yield strategy, there are ETFs that focus on a basket of stocks with higher than average yields. Some of the most popular and largest dividend ETFs include the Schwab US Dividend Equity ETF, ticker SCHD, the Vanguard High Dividend Yield ETF, VYM, and the Spider Portfolio S&P 500 High Dividend ETF, SPY-D. The Schwab ETF, SCHD, is a huge fan favorite because it uses a really smart screening process. It looks for companies with a history of paying dividends, but it also filters for financial strength, like return on equity and strong cash flow, to build a portfolio of what it considers high-quality, sustainable dividend payers. The Vanguard ETF VYM takes a wider approach. It essentially invests in a broad range of U.S. stocks that are expected to have above-average dividend yields, giving you massive diversification across over 500 companies. And if you want to invest beyond the U.S., there are even international dividend ETFs that hold strong dividend-paying companies from all over the world, which diversifies your income sources even more. One crucial thing to look at when picking an ETF is its expense ratio. This is just a small annual fee the fund charges for operating costs. You want this number to be as low as possible. Big names like Vanguard and Schwab are famous for their super low expense ratios, often just a few hundredths of a percent, which means more of your money stays invested and working for you. For any beginner or really anyone who wants a more hands-off approach, dividend ETFs are one of the best ways to start building that passive income stream right away. You get diversification, simplicity, and a professionally chosen portfolio, all in one. Your 5-step plan to earning your first dividend theory is one thing, but let's make this real. Here is your step-by-step plan to go from zero to earning your very first dividend payment. Set a clear goal. You wouldn't start a road trip without knowing where you're going, right? Investing is the same. What are you trying to accomplish? Do you want an extra $100 a month? $500? $1,000? Knowing your target helps you figure out the scale of what you need to build. Let's do some simple math. If your goal is $1,000 a month, that's $12,000 a year. If you build a portfolio with an average 4% dividend yield, you'd need about $300,000 to hit that goal. If you manage to get a 6% yield, that number drops to $200,000. Now, don't let those big numbers scare you. Nobody starts there. The whole point is to have a clear target to aim for. Open a brokerage account. To buy stocks or ETFs, you need a brokerage account. It's basically the bank account for your investments. There are tons of great low-cost online brokers out there today like Fidelity, Charles Schwab, or Robinhood. Opening an account is usually free and can be done online in about 15 minutes. Choose your tool, individual stocks or ETFs. This is where you decide on your approach based on what we've talked about. If you have the time and you're interested in the research, you might want to build a portfolio of individual stocks. A good rule of thumb is to aim for a mix of 20 to 30 different companies across various sectors. Think healthcare, consumer goods, utilities, and financials. This spreads out your risk, so if one company runs into trouble, it doesn't sink your whole portfolio. If you want the simple, hands-off approach, you'll go with a dividend ETF. You could just pick one of the big ones we mentioned, like SCHD or VYM, and make it the foundation of your entire dividend strategy. Unleash the power of compounding with DRIP. This is probably the most powerful tool for building wealth over the long term. Most brokers offer something called a dividend reinvestment plan, or a DRIP. All it means is that when a company pays you a dividend, instead of that cash just sitting there, your broker automatically uses it to buy more shares of that exact same stock or ETF. This creates a kind of magic compounding effect. Those new shares you just bought will then earn their own dividends, which then get reinvested to buy even more shares, and the cycle just keeps going. It's like a snowball rolling downhill, getting bigger and bigger all on its own. Especially in the early years of investing, a DRIP is your absolute best friend. It puts your passive income machine on autopilot and seriously speeds up your portfolio's growth. Start small, but start now. This is the most important step of all. Just get started. You do not need thousands of dollars to be a dividend investor. You can open an account and buy your first share of a dividend ETF for $100 or even less. The real key is building the habit of investing consistently. Set up automatic transfers from your bank to your brokerage account every single month, even if it's just $50 or $100. Consistency is so much more important than the amount you start with. Every dollar you invest is a seed you're planting for your own financial freedom. Section 5. How to avoid the common mistakes. Investing always comes with risk, but smart investors know how to manage it. With dividend investing, there are a few specific things you need to watch out for to protect your money and your income stream. First, like we touched on before, you have to learn to spot and avoid yield traps. An unusually high yield, I'm talking double digits, is almost always a warning sign, not a golden opportunity. It often means the stock's price has collapsed because of deep business problems, and a dividend cut might be just around the corner. Always look past the yield. A healthy company with a 3% yield is infinitely better than a struggling one with a 13% yield. Second, always check for dividend sustainability. How can you tell if a dividend is safe? Look at the company's cash flow. A business needs cash to pay its bills, grow the company, and pay you a dividend. If a company is borrowing money just to pay its dividend, that's a huge red flag. Also, look at the company's history. Has it paid dividends consistently? Does it have a track record of raising them? Stability is a great sign. Third, remember that dividends are not guaranteed. A company's board of directors can choose to cut or completely eliminate the dividend at any time, especially if the economy takes a bad turn. This is another reason why diversification is so important. If you own 25 different stocks and one cuts its dividend, it's just a small bump in the road. But if you only own 1 or 2 stocks and one of them cuts its dividend, it can be a disaster for your income. Diversification is your best defense. Finally, you have to manage your own emotions. Stock prices are going to go up and down. That's just how the market works. Beauty of dividend investing is that even when the market is choppy, you can still collect that steady stream of income. Don't panic and sell everything when things go down. In fact, market downturns can be the best times to buy more shares of great companies while they're on sale, which locks in a higher dividend yield for you. Focus on your long-term goal and the income you're generating, not the day-to-day noise. I know we covered a ton of ground today. We went from the simple definition of a dividend all the way to exploring strategies like dividend growth and high-yield investing. We talked about how ETFs can be an easy button for beginners and laid out a clear 5-step plan for you to get started. Building a serious passive income stream from dividends isn't a get-rich-quick scheme. It's more of a get-rich-reliably strategy. It takes time, patience, and consistency. But it is one of the most proven and accessible ways to reach true financial freedom. Every dividend you reinvest and every dollar you contribute to your portfolio is a step towards a future where your money works for you. A future that gives you more choices, more security, and more freedom to live life completely on your own terms. The power to start building that future is in your hands right now. I really hope this video cleared things up and gave you the confidence to get started. If it did, please give this video a like and think about sharing it with someone who might find it helpful. And for your next step, I want you to leave a comment below. Tell me, what is one dividend stock or ETF you're going to start researching after watching this? I read all the comments, and it's a great way for all of us to learn from each other as a community. Thanks for watching, and I'll see you in the next one.